What is an index fund? In an index fund, the index applies 2 to 3 rules for stock selection and weight allocation. This is applied to a predefined universe. While in an active fund portfolio, the fund manager bases his decisions for stock picking on some ground up criteria, and this criteria can be different for different stocks at different points in time. Like how music playlists can reduce time for in the moment decision making, and you can enjoy uninterrupted music of respective genres. Similarly, rules under index construction can do two things: make things simpler as they reduce decision-making time, and provide room for consistency as discipline, as the rules take away the judgment from the decision-making process. Thus, one should consider diversifying into the discipline of passive investments too. Index funds do replicate indices, but firstly, it's important to understand what is being replicated or what is being tracked. Whether it is the broad market indices which is being replicated for market returns, or is it the thematic, sector or factor indices which is being replicated for higher risk, higher return profile as compared to broad market indices. Second, indices do not remain static. For example, in the broad market indices like Sensex and Nifty 50, these sectors which are heavy weighted today like banks, finance, IT software did not feature heavily in the 1980s in the benchmark. Whereas textiles and steel featured heavily in the index in 1980s, and that's not the case anymore. Regular little changes in the index happen over a long period of time, and this helps in chasing and capturing the evolving economy or the theme or the sector in its entirety. One should consider diversifying into the discipline of index investing. So why wait? Invest now with Tata Mutual Fund and own a piece of India's progress.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.